Good afternoon. Welcome to the September Quarterly Super Update. My name is Mylene Wheeler and I'm a Superannuation Advisory Manager here at Vincent's. So first, let's start with our little important disclaimer. All right, so here are my contact details if you have any questions that you want to send through to me after the webinar presentation. Okay, so here's our agenda for today's Super Quarterly Update. So we're going to look at the upcoming important superannuation tax dates that you may need to be aware of. We're going to have a look at some of the ATO website updates that specifically impact superannuation. Going to have a quick update of the status of superannuation legislation since our last webinar, including a brief discussion of the private members bill that was introduced by Rebecca Sharkey, the Fair Work Amendment Recovering Unpaid Super Bill, which aims to change and strengthen the super system through a number of means. We're also going to look at the super guarantee compliance measures that were announced by Kelly O'Dwyer in August 2017. Going to have a brief little look at some of the statistics released by the AFSA Retirement Standard June 2017 quarter. And we're going to look at the ATO's clarification on requirements for claiming ECPI and actuarial certificates. And then a bulk of this webinar is going to be looking at the transfer balance cap and the SMSF report-based reporting framework and the TBAR report that was released by the ATO. Okay, so here's a slide with some of the key dates that are coming up. Now, one thing to be aware of is that this doesn't include the lodgement deadlines for activity statements and PAYG instalment notices. It's a list of key dates and it's not comprehensive and it's just a guide. Okay, so legislation updates. So let's start with bills introduced to Parliament. So on September the 11th, Rebecca Sharkey introduced a private members bill into Parliament called the Fair Work Amendment Recovering Unpaid Super Bill. So as I mentioned before, it aims to change the superannuation system through a number of means. So what it seeks to do is to strengthen the Australian super system by including super contributions with the National Employment Standards, which enables the Fair Work Ombudsman to engage its authority in matters that relate to super contributions, such as recovery of unpaid employer superannuation contributions. This provides employees with the direct legal avenue to recover unpaid super. Another measure is that it will enable employees to more effectively track if and when super contributions are made to them by their employers, by requiring employers to provide notice of when contributions are made and not made for each pay period. There's also the removing of the exemption that currently exists for employees that allows them to not make superannuation contributions to employees who are paid less than $450 by way of salary or wages per month. Looking at removing the restrictions on choice of superannuation funds from 1 July 18 as affected via certain agreements and workplace determinations. Also looking at requiring the Commissioner for Taxation to conduct a review of employers' compliance with their superannuation payment obligations as they occur under the Superannuation Guarantee Administration Act 1992 and other relevant laws, and including recommendations to improve compliance. This review could be conducted as soon as practicable and after 12 months from the commencement of the Act, and the resulting report will be tabled to Parliament soon after it is given to the Minister. And finally, looking at creating a duty for trustees of super entities to take reasonable steps to notify their members within 28 days and by any means when it could reasonably have expected to have received a contribution on behalf of the member from an employer but did not. It is expected that these measures will remove exemptions that currently reduce the amount of super contributed to employees by their employers, enhance the ability of employees to recover unpaid super from their employers, and allow the federal government to track super more effectively to inform public policy and to help identify problem employers. Okay, so next slide. These are the bills that are currently before Parliament. The following super-related bills remain before Parliament. So we have the Superannuation Objective Bill from 2016, which proposes to enshrine the primary objective of the superannuation system in law. In his second reading speech on the bill, the Treasurer explained that the bill enshrines in law that the objective of the superannuation system is to provide income in retirement or substitute to substitute or supplement the age pension. The subsidiary objectives of super would be prescribed through regulations. The bill was passed by the House of Reps in November 2016 without amendment and is currently before the Senate. We have the Treasury Laws Amendment, Reducing Pressure of Housing Affordability Measures, number 1, Bill 2017, which is currently before the House of Reps. This bill establishes the First Home Super Saver Scheme, which allows first home savers who make voluntary contributions to their superannuation to withdraw these contributions and an amount of associated earnings for the purposes of purchasing their first home. It also allows an individual to use the proceeds in relation to a one-off sale of their main residence to make contributions, known as the downsizer contributions, of up to $300,000 to their superannuation provider if they are 65 years of age or over. Downsizer contributions can be made regardless of any other contributions caps and restrictions that might apply to making voluntary contributions. And finally, we have the First Home Super Saver Tax Bill 2017, which is currently before the House of Reps. This bill implements the First Home Super Saver Tax, and individuals who do not purchase their first home within a specified period can either recontribute amount into superannuation or pay the First Home Super Saver Tax to unwind the concessional tax treatment that applied on the release. So these are the bills that have been referred to Senate committees, and they have been referred to the Senate Economic Legislative Committee. We have the Treasury Laws Amendment, Improving Accountability and Member Outcomes in Superannuation Measures, number 1 bill. This has been referred to the Senate Economics Legislation Committee for report by the 23rd of October 2017. We have the Treasury Laws Amendment, Improving Accountability and Member Outcomes in Superannuation Measures, number 2 bill, which contains amendments to the Superannuation Guarantee Administration Act 1992 to provide that employees under workplace determinations or enterprise agreements made on or after 1 July 2018 have the right to choose their superannuation fund, and provide that amount sacrificed under an employee salary sacrifice arrangement will not reduce an employer's mandated superannuation guarantee contributions. Lastly, we have the Superannuation Laws Amendment, Strengthening Trustee Arrangements Bill 2017. This doesn't impact SMSF, but this bill introduces new trustee arrangements requiring registrable superannuation or RSE licensees to have at least 1/3 independent directors, and for the chair of the board of directors to be one of these independent directors. It also requires that RSE licensees that are a group of individual trustees have at least 1/3 of the trustees that are independent. All right, let's move on to some of the ATO website updates that impact super. So what we have is SMSFs and reserves. So following on from the post-July 1 super changes, the FAQ section have been updated to include a question and answer involving the use of reserves to keep total super balances down or to ensure that the transfer balance cap isn't exceeded. The frequently asked question looks at whether members can set up a reserve to ensure that they do not exceed their transfer balance cap, or to keep their total super balance down so they can still make contributions and access the new carry forward arrangements that apply. The ATO has advised that they are closely monitoring use of reserves by SMSFs following the introduction of these new limits and restrictions, including the transfer balance cap and total super balance. While the establishment of a reserve is not specifically prohibited, the ATO considers that there are very limited circumstances in which it is appropriate for a reserve to be established and maintained in a self-managed super fund. The use of reserves beyond these circumstances may suggest that they are being used as part of a broader strategy to circumvent the new limits and restrictions. So any unexplained increases in the creation of new reserves or in the balances of existing reserves maintained by SMSFs is likely to attract close scrutiny from the ATO. So further guidance on when it may be appropriate for an SMSF to establish and maintain a reserve will be issued by the ATO. In the meantime, if you are considering using reserves in your SMSF, we strongly recommend that you seek independent professional advice and approach us before doing so. So the next one we have is that the ATO has updated the webpage to highlight and remind trustees of the obligation to provide written notice to the ATO of any changes of the details of SMSFs. So as a trustee of an SMSF, you must give the ATO written notice within 28 days if there is any change to the following: the name of the fund, the address of the fund, details of the contact person of the fund, change in the membership of the fund, change in the trustees of the fund, or change of the directors of the fund's corporate trustee. The ATO has also released the SuperStream Benefits Report that shows that 95% of superannuation payments are now digital, following a 5-year rollout of SuperStream. The report identifies an improved employer experience due to simplified electronic processes, resulting in super contributions from employers sent through a single channel, reducing the average time that employers are spending processing super contributions by about 70%. The ATO has said that there's estimated savings of $2.4 billion per year for fund members, with an estimated $800 million in realised efficiencies for employers and APRA funds. The report confirms the magnitude of the industry-wide shifts in productivity and efficiency, and it's shown that approximately 17 million fewer cheques are handled each year by funds, which is an 87% reduction since the original Cooper review. There's over an 85% straight-through processing rates in contributions, and over 95% of straight-through processing rates for rollovers now allowing automated allocation to a member's account. There's over 6 million member identity matches per year due to the integration of the ATO's tax file number validation service into fund administration processes. This has resulted in a reduction of fund complexity for employers from a median of 30 sending channels that they used to use to process down to 1 or 2. It's also strengthened the identification from tax file number usage for member accounts, which has reduced the number of lost member and unclaimed monies while helping members recover and claim these monies. And there's a faster overall allocation of money to accounts, which results in members earning at their nominated investment rates at the earliest possible time. So the fourth change to the ATO website that affects super that we'll be talking about is access to the super clearinghouse. So more employers now have access to the Small Business Superannuation Clearinghouse, known as the SMSF, which distributes and makes payment to employees' super funds. So employers can now use the SMSF if they have 19 or less employees, or they have an annual aggregated turnover of $10 million or less. So to better serve the growing number of users, the SMSF will be integrated with the ATO's online services in the business portal in early 2018. The ATO has released its estimate of the superannuation guarantee gap for the 2014-15 financial year, which reflects the difference between the theoretical amount of super payable by employees to be fully compliant with their SG obligations and the actual contributions that were received by funds. So the ATO has estimated that the net SDG gap was around $2.85 billion for the 14-15 year. Excuse me. Right. So moving on from this gap in the SG, in late August, the government announced measures that would give the ATO real-time visibility over superannuation guarantee compliance by employers. The government also said that it's going to provide the ATO with additional funding for a superannuation guarantee task force, which would target employer non-compliance. So the measures include requiring super funds to report contributions received to the ATO more frequently, at least on a monthly basis. This will enable the ATO to identify non-compliance and take prompt action. Another measure was rolling out a single-touch payroll system, such that employers with 20 or more employees will transition to STP from 1 July 2018 and smaller employers from 1 July 2019. So this is looking at reducing the regulatory burden on business and transforming compliance by aligning payroll functions with regular reporting of taxation and superannuation obligations. Another measure is it's aiming at improving the effectiveness of the ATO recovering power, including strengthening director penalty notices and the use of security bonds for high-risk employers. And finally, allowing the ATO to seek court-ordered penalties in serious cases of non-payment, including those employers who are repeatedly caught but fail to fulfil their obligations. So the measures reflect the key recommendations in the final report to the SG Cross-Agency Working Group of 14 July 2017. It builds on legislation that is already announced to close a legal loophole used by employers against employees who make salary sacrifice contributions to their super. Okay, next up, we're just looking quickly at the AFSA Retirement Standard June 2017 quarter. So they released their June 2017 quarter retirement standard figures, which show that the required budget for those living a modest lifestyle has increased by an annual rate of 2.1%, while those living a comfortable retirement saw an annual increase of 1.5%. Something's happening with that slide there. There we go. So the figures show that couples aged around 65 living a comfortable retirement need to spend $60,063 per year, and singles $43,695, which is up 0.2% on the previous quarter. Now, for those who are at a modest retirement levels, singles need to spend $24,270 per year and couples $34,911 per year, which is up 0.1% on the previous quarter. The annual increase in living costs at the modest level was in each case higher than at the comfortable level, which reflects the greater relative importance of electricity, healthcare, and council and water rates in the modest budgets. It was noted that the cost increases for retirees were highest in Sydney, Adelaide and Hobart and Canberra. Brisbane's not on the list, which just reinforces that Brisbane is the place to be. All right, next slide up is that the ATO has clarified the requirements for claiming ECPI and actuarial certificates. So the ATO has updated their guidance material to confirm their view on the requirements for claiming a tax exemption on pension assets, and in particular, when to obtain an actuarial certificate. So this is all about when you're in pension phase, there's a certain part of the income that will be exempt from tax, and also you prorata your deductions. So where a fund is wholly in pension phase for all or part of any income year, the ATO's position is that all of the fund's assets are segregated current pension assets. So an actuarial certificate is not required to support the SMSF's trustee calculation of exempt current pension income for the relevant period. This is generally standard practice, but what they've come out now and said is that for any portion of an income year that an SMSF is not wholly in pension phase, for example, the members have a mix of pension phase and accumulation interest for part of the year, so they might have been fully in pension and started to put money into the super fund at some point mid-year, then the SMSF assets are not segregated, then the SMSF trustees will be required to use the proportionate method to determine its ECPI for that period. So they will also be required to obtain an actuarial certificate if they wish to claim ECPI in relation to income received by the fund during that part of the income year. Industry practice has generally been to get an actuarial certificate and do the ECPI for the full year, not the portion. So in its guidance, the ATO has acknowledged that there may be some industry practices that may not be in accordance with this view regarding the calculation of ECPI. So the ATO has made an administrative concession in relation to its compliance approach for the 2016-17 income year and prior. However, they are requiring for the 17-18 income year and onwards that the ATO will require SMSF trustees to calculate the ECPI and obtain actuarial certificates in line with this position. All right, and transfer balance cap and the SMSF event-based reporting framework. So at our last quarterly update, we briefly discussed the ATO's proposal to introduce event-based reporting for SMSFs, where the funds will have to report certain events to the ATO in real time due to the superannuation changes which commenced from 1 July 17. It was all back then, it was just we were hearing rumours, nothing was quite official. So since our last update, more information has been released from the ATO around their position on the reporting requirements. So from 1 July 2017, there is a new limit on the total limit that an individual can transfer into retirement income streams, such as pensions and annuities. This is known as the transfer balance cap, or the TBC. It also includes income streams that an individual may be entitled to, such as death benefit income streams. The TBC commenced with a limit of $1.6 million. This will be reviewed annually and indexed in $100,000 increments that are in line with CPI. So from the end of 30 June 2017, the concept of total superannuation balances commenced, which is a way to value your total super interest on a given date. Your total super balance is relevant for working out your eligibility for the unused concessional contributions cap carry forward, the non-concessional contributions cap and the 2 or 3 year bring forward period, the government contribution, and the tax offset for spouse contributions. Where you're over $1.6 million, you aren't entitled to any of these things anymore. So in order to effectively administer the TBC and the total superannuation balance, superannuation providers will be required to report events to the ATO via a transfer balance account report, which is referred to as TBAR. Now, since our last webinar, the ATO released a position paper, and they also updated the website with information on events-based reporting by SMSFs to outline its position on how SMSFs will report under the new TBC measure in the 2017-18 year and onwards. So, super providers, including SMSFs and life insurance companies, will be required to lodge a TBAR to report events relating to an individual's transfer balance account, or a TBA. To ensure accurate data matching for the member, it's important that their income stream account number will be included when reporting an event. So events to be reported in TBAR include super income streams in existence just before 1 July 2017, and any of the following events that occur on or after 1 July 2017. So that's our super income streams that have commenced in retirement phase, limited recourse borrowing arrangement payments, member commutations, compliance with the commutation authority issued by the Commissioner, personal injury structured settlement contributions, and super income streams that stop being in retirement phase. So, sorry, skipped a few slides here, but only certain events that affect a member's transfer balance account or total super balance need to be reported in the TBAR. Events that do not need to be reported include pension payments, investment earnings or losses, and when an income stream is closed because the interest has been exhausted. Okay. A transfer balance event notification, or a TBEN, form will be used by individuals to report some information to the ATO directly. Typically, a TBEN will be lodged when the following event occurs. So there may be a family law payment split, a debit event which has occurred due to fraud, dishonesty or bankruptcy, or a structured settlement contribution made before 1 July 2007. So under position paper, the ATO sought feedback on how often SMSFs will be required to report events impacting an individual member's transfer balance account from 1 July 18. This was based upon 2 possible alternative options. The consultation period ended on the Friday 15th of September 2017. So the events that are required to be reported are exactly the same under both options. It is only the timing of reporting those events after 1 July 2018 that is different under the 2 options. So our option 1 for TBAR reporting is that from 1 July 2018, self-managed super funds will be required to report events occurring in relation to their members' transfer balance account 10 business days after the end of the month in which the relevant event occurs. There are exceptions to this. This is when you commence an income stream. So there's an administrative concession which will allow SMSFs to report the commencement of a retirement phase income stream, or a pension, to 28 days after the end of the relevant quarter. Limited recourse borrowing arrangements. So there's an administrative concession which will allow SMSFs to report relevant repayment events to 28 days after the end of the relevant quarter. And commutation authorities. So SMSFs must abide by the legislated TBC reporting timeframes as specified within the commutation authorities. Under option 2, from 1 July 2018, self-managed super funds will have 28 days after the end of the relevant quarter to report all TBC events except for the commutation of an income stream because the ATO has issued a member of an SMSF with an excess transfer balance determination, which will need to be reported within 10 business days after the end of the month in which the commutation occurred. Otherwise, the ATO may issue the fund with a commutation authority that will require you to remove the excess even if the member has already done so. And compliance or non-compliance with the commutation authority to the ATO has issued to an SMSF. So the SMSF must abide by the legislated TBC reporting timeframes as specified within those commutation authorities. Following an appropriate transition period, SMSFs will then be required to move to reporting all TBC events to 10 business days after the end of the month in which a relevant event occurs, other than compliance or non-compliance with the commutation authority, which again we've said will need to still occur within its specified time frame. Now, the ATO is considering, under option 2, that an appropriate transition period for SMSFs to move from quarterly to monthly reporting of all TBC events will more than likely be 2 years until the end of 30 June 2020. So although SMSFs will generally not need to commence TBAR reporting until 1 July 2018, SMSFs and their trustees need to ensure that they have appropriately documented income stream valuations and decisions for the 17-18 year. Until reporting begins, SMSF members must monitor the value of retirement income streams they receive to ensure that they don't go in excess of the transfer balance cap of 1.6 million from 1 July 2017 onwards. Okay. So TBAR considerations. So the introduction of TBAR highlights the importance of talking to your superannuation administrator or your accountant before commencing pension payments, before you make any additional non-concessional contributions into your fund. You need to do this to not only ensure that you're eligible to do either of these events, but also to ensure that these will accurately be reported to the ATO in the prescribed time frame. It also stresses the importance of record keeping and really ensuring that you have the right processes in place with your administrator, your accountant, and financial advisors to ensure that you can report to the ATO on a real-time basis. So this can include simple steps such as setting up auto forward rules that forward any emails relating to any super income or expenses directly to your accountant. You know, these include your monthly rental statements that might come through. We're really moving away from a give everything to your accountant in the shoebox at the end of the year. That's not going to work moving forward. So just getting into the habit of copying, scanning paper invoices or notices as you pay them, mailing them, scanning them, emailing them, or even uploading them to a portal that your accountant may use, like we do here at Vincent's, is going to be the way of moving forward. Now, as I briefly mentioned in the last super update, we use Class Super software. So with Class Super software, we can access daily, secure, direct connect data feeds from over 180 banks, brokers, and wraps. So this gives us the ability to determine your total super balance in real time, as long as you've given us all the other information as well, because sometimes we have bank accounts that aren't on feeds. So as I said, talk, communicate with your accountant. It really is going to be vital moving forward. Okay, so on this slide, the next two slides actually will show you the paper copy of the TBAR, which was published on the ATO website on the 22nd of September. It's a 6-page document. So there will be 3 channels for trustees to report the information to the ATO. This will be submitting a data file via the business portal or the tax agent portal, which will be available from 1 October 17, so that has already started. You can post or you can fax this paper report, also that was available from 1 October. Or, whoops, getting too excited and moving ahead. or you can do electronic lodgement via the ATO online services, which are available from 1 January 2018. Now, only one event per member can be reported in this TBAR if you lodge a paper form or you use the ATO online services. So if you have multiple events, such as you are stopping and starting a new pension, then for multiple members, then you're going to have to do a separate 6-page report for each event. Okay, so this concludes today's quarterly super tax update. If you have any questions, please do not hesitate to contact me on the details listed here. I have seen a question that will we be sending out these slides? The video will be uploaded to our YouTube channel. However, if you wanted to send me an email directly, I can make sure that you will be emailed a copy of the presentation slides shortly. All right. Thank you and have a good weekend.